The Reddit rebels have a new target. Disney CEO Bob Chapek. Shareholders taking to Reddit in a thread called "Unhappy with the current state of Disney parks." And what they're trying to do is devise a plan to vote out the CEO at this year's annual meeting. The shareholders in a thread are outraged at the Mouse House CEO for soaring prices at the theme parks, long lines, and declining customer service, with one user writing, quote, "The magic is gone." This, as the happiest place on earth gets set to release its quarterly report after the closing bell. The stock is moving higher by 3%. Disney's estimated to hit an EPS of 63 cents and $20.91 billion in revenue. Let's bring in CFRA Research senior analyst Tuna Amobi, who has covered Disney stock for decades, and Slated co-founder and executive chairman CEO Stephan Paternot, which is a film packaging and financing site. Great to have you both. All right, Tuna, go for it. What are you expecting here, and what is the most important thing Chapek has to do to calm people out there? And do you put any credence into this Reddit website that says this guy's got to go?
Good afternoon, Liz. No, I think really it's been a baptism of fire of sorts for Bob Chapek. He hasn't had any easy ride at all. I mean, it seemed like the pandemic really threw a major curveball at him. I wouldn't really, quite frankly, put a lot of credence on what's going on with the Reddit crowd. I know every once in a few years you hear some of these, governance, skirmishes. But I think what's different now is that, you've got a pretty new CEO who's trying to, get his hands on the ball. Streaming is going to be a huge part of the outlook and how investors perceive this name. I think we've seen some of the other platforms that report it, raising some concerns about the deceleration in the secular growth outlook for streaming. We think that, those concerns are overdone. That being said, I think the expectations for this quarter that Disney is going to report are very, very tempered. I will look to the back half of the fiscal year for some type of reacceleration. So if you're a Disney shareholder, obviously, you're not pleased with the way the stock has underperformed over the last couple of years. But on the positive side, you've got some of the major traditional businesses really getting some traction coming out of the pandemic. We know the theme parks, has been really getting a lot of the benefit of significant pent-up demand. And talking about the criticism against, Bob Chapek, the pricing power is really through the roof. If you're a theme park, customer, you're really feeling that pain. But that's a good thing, if you're an investor, because that really shows that there's a lot of people out there waiting to get back to the theme parks. And that business, as you know, Liz, took a major hit. So when you balance everything out, we're still kind of pleased. It's kind of still too early to make a definitive call out there. This is a marathon and not a sprint. So that's why we kind of have a buy recommendation right now.
Well, because we're still, seeing the after effects or the effects of the pandemic. Steph, clearly Tuna is a believer in Disney. Here's where the problem comes. Yes, they have some momentum behind their streaming, although it slowed down in the last quarter. I look at this and I say they have too many masters to deal with and to please when it comes to content. They've got the streaming business, which is really hungry for great content, but they still have their linear legacy business. Their channels out there, Disney Channel, FX, and ESPN, they've got to fill that with content, and people are cord cutting. So how do you square the two, especially considering that each, let's say, Disney group of channels out there, the old linear cable and satellite business, is about $17 per subscriber, yet it's just $6.99 per subscriber for Disney Plus.
Well, I think there's much ado about nothing here, and I don't really focus ever on the short-term earnings. I look just at the macro picture. So first off, just like when Tim Cook took over from Steve Jobs, that was a very big act to follow. And I think the same thing here is following Bob Iger was no easy task. And taking over when the pandemic hit was a Herculean effort. I think overall, he's done a really good job, all things considered. Now, regarding Disney's streaming prospects, I mean, this is still all about a hit-driven business. And the beautiful thing is that unlike Netflix, Disney is highly diversified with their revenue lines. They've got the theme parks. Yes, maybe there's pricing issues there, but again, they own that market and they can raise the prices. And they also have box office. They're going to be releasing Black Panther. They're going to be releasing another Thor. There's going to be a Doctor Strange. There's going to be another Pixar movie. They have a lock on major IP franchises hitting the box office this year, all of which can go onto their streaming platform. So I think ultimately the name of the game is if you can generate hits on a quarterly or more frequent basis, you'll keep drawing audiences in. Whether it's streaming or box office, Disney is the best at this.
Tuna, we're looking at the way they do draw people in. They've got the great franchises with Star Wars and Marvel. However, when you look at the streaming, they've got all of those people now. They've got all of those customers. How do you get the customer that likes the content that's out there, say, on Netflix, the Bridgerton or anything? You could look at Squid Game or what was the chess one? Or my favorite, Cobra Kai. They don't have that stuff yet. Queen's Gambit.
That's a great question, Lisa. What I like about the strategy that Disney has really adopted here is they call it a four-quadrant strategy. So when you kind of look at the Disney Plus platform, I think they really done a great job to kind of putting content there that appeals to as broad an audience demographic as possible. And that's really the playbook here that we see a lot of streamers trying to adopt. Now, it's also a good idea to have niche and differentiated content, but ultimately, if you want to be successful in this game, you've got to have content that appeals to a very wide audience, not just internationally and also not just in the U.S., but also internationally. One of the things that Disney has emphasized as they continue to launch globally is the idea to really invest heavily in local and regional content. And they have literally hundreds of shows of local and regional content in the pipeline as we speak. So, which is why they kind of talk about doubling the amount of content they have this fiscal year. And you're kind of looking for that spending to hit north of $10 billion in a couple of years from literally $2 billion. So, this is a huge undertaking, and it's really not for the faint of heart. And I think investors understand that Disney is on a very different trajectory compared to Netflix, which took a much longer time to get to their first 100 million. Disney is a much faster pace, but you're likely to find some speed bumps, and that's really what the trepidation has been lately.
I'm rushing you along. Because, Steph, we only got a few seconds, but what is the biggest blockbuster that will come out this year that will really help Disney?
Oh, I mean, on theatrical, it could be Black Panther. It could be Doctor Strange. I mean, we all saw how Spider-Man just performed, but also on their streaming service, Obi-Wan for sure is going to be a huge draw. Okay.
Great to see you both. Tuna, Steph Paternot, great to have you. We'll be watching for Disney numbers after the bell. We are coming right back with Charlie Gasparini.